Good morning, everyone. Today I thought I would try something a little bit different, a bit of, I guess, education, starting from scratch. Please forward this to anyone that you might find value. Today I'm going to talk about the very basics, starting right from the beginning, for beginners, really, on what is the stock market. And what it's all about, how people invest in it, why do people invest in it, what's the point, or what's the history of it, and how do you make money from it ultimately. So let's get going. Let's start right at the beginning. So what is the stock market? As the name implies, it's a market where stocks are traded, bought and sold. I guess you get other types of markets. You get markets for livestock, where cows and pigs and sheep, etc., are bought and sold. And I guess a normal grocery store or any retail supermarket is also a type of market. But on the stock market, we only trade stocks. So what is a stock? A stock is a unit of a company, of a shareholding in a company, a unit of ownership in the company. So another name for stocks is shares, as well as equities. It all means the same thing, and it gives you ownership in a company. So typically a company would issue a few million shares, or in some cases hundreds of millions of shares or stocks, and the public can buy into those shares or stocks. The more shares or stocks you own, the greater percentage you own of the company. So typically the life cycle of a company starts off very small. Let's just give a hypothetical example. Let's say you're very good at making shoes, and you make amazing shoes, and you start making them in your garage, and all your friends love your shoes. They think they're amazing, and they all want to buy them. So you sell a handful of them, but you find yourself under too much pressure. You just can't keep up with the demand. So let's say you bring on a partner, a friend or family member, and they say they'll help you out with it, and they'll try take the orders from the customers and grow the business, and maybe expand the factory as well. So let's say you each put in $10,000 or 10,000 Rand, depending on where you're from. You put in $10,000, let's just say, and your friend puts in $10,000. Now you each own 50% of the company. The company has got $20,000 invested into it. But let's talk about what is a company actually. So a company really is a legal entity that can own property. It can engage in transactions. It can have a bank account. It's a legal entity, so it's not a person. You can't touch it, you can't see it, but it does have rights in terms of the law. So it can engage in contracts with people as well, and other companies as well, and it's essentially immortal. A company can be around for hundreds of years. It doesn't die. So you would, let's just say, start a company, as I said, with your friend. Now you've each got 50% ownership of the company. And you start growing. More and more people start buying your shoes, but now you need to expand. You need let's just say, a bigger factory. You need to employ people, and to do that you need money, or capital. And to raise capital, there are two ways of doing it. You want to buy, let's just say, a factory. You can either go to the bank and borrow money from the bank, or you can take on new investors in your business. And they can invest the money into your business to help it grow. So typically what people do at that stage is they approach friends or family to try and grow their business, and they might sell, 10% of their business, whatever the case may be, and the family and friends invest their money. Let's just say it keeps on growing. It's a great success story. The demand just keeps on increasing. And after your friends and family have invested, it grows even bigger. Now you want to take it to the next level. You want to maybe start expanding in other cities, perhaps even other countries. Now you need more money. And at that stage, you would typically go to venture capitalists. So these are companies that invest in companies before they list on a stock exchange. If you can find a venture capitalist or a venture capital company to invest in your company, they would also expect a return after a number of years. And if they invest in your company, let's assume it goes well, it continues growing, you expand into other cities and other countries, you build more factories, and eventually it reaches a stage where you want to grow it even larger, even you want to, let's just say, go international and start selling your shoes all over the world, spending way more money on marketing and advertising. That again requires even more money, more capital. So at that point, you'd consider listing on the stock exchange and raising money from the general public, as well as institutional investors that invest on the stock exchange, such as pension funds, fund managers, etc. So then once you've listed on the stock exchange, your shares in your company will be available to be traded by the general public. And anyone who opens up a stockbroking account at a stockbroker like ourselves, through me at AfriFocus Securities, you could then buy shares on that company that has been listed. So that's the general life cycle of, I'm just generalizing, a fictitious company that gets, starts off very small and grows and ultimately gets listed on the stock exchange. There are stock exchanges all around the world. Here in South Africa, we have the Johannesburg Stock Exchange, and there may potentially be other stock exchanges I see that there's talk of one being listed in Cape Town, but we'll see what happens there. There are stock exchanges in America. The NASDAQ and the New York Stock Exchange are the most popular ones there. Canada, the UK, most European countries, Japan, Australia, Hong Kong, China, most countries have a stock exchange. And the idea really is to help companies get access to more capital, more money to expand their businesses and grow their businesses. That's the rationale why companies list on a stock exchange, and it's really just so that they can expand. And it's an alternative to borrowing money from a bank or other financial institution to get access to capital or money. So that's the life cycle before a company gets listed, and when it does get listed, it's called an IPO, or initial public offering. That's when the company is ready to get listed, and investment banks help with that process of listing it on a stock exchange, and they would approach institutions and the general public at large to list it. So once it's been listed, what happens then? Then, as I say, the general public can buy shares into the company, and they can sell it. And the original investors, the venture capitalists and the founders of the company, they can sell some of their shares or all of their shares, if they like, to the general public and institutions. So, that's a way of the founders and the venture capitalists of cashing in, really, some of the investment. But if they believe in the company for the longer term, they would hold on to it, and for the long term, hoping that the share price would grow and grow and grow over the longer term. So that begs the question: what makes a share price go up or go down? Why do people buy? Why do people sell? So there are obviously lots of different reasons for that, but a big reason is expectation of future dividends. So companies can declare a dividend, which is a payout every so often when after they release their results. They have to publicly release their results, and if they like, they're not obliged to pay a dividend. But if they have a bad year, they may decide not to declare a dividend. But if they have a good year, typically they will declare a dividend and pay out a certain amount of money to their shareholders. So when you're investing in the stock market in companies listed on the stock exchange, you would want to receive those dividends. Now, if the prospect in, let's just say, the next 3, 6, or 12 months is that the company is going to do even better, the general environment, the economy, etc., the industry that they're in, the demand for their products or services is increasing, then people expect that their earnings will go up. And if the earnings go up, they should be in a better position to pay a dividend. So it makes their share price, their company more attractive, and people will want to buy their shares. And if obviously the other way around, if it looks like they're having a bit of a bad time, it could be a temporary thing, or it could be a more permanent thing where the demand for their products is going down, then their earnings are likely to go down as well, and less of a chance of them paying a good dividend. So people would probably sell those shares. There are other things that could happen as well. Perhaps a large company is looking at buying out the company. That could also push the share price up. Perhaps they found a new technology that could also push the share price up. Perhaps they are also looking at buying out other companies and growing the company that way by acquiring other companies. They could also push the share price up. And another one which a lot of people miss, which is very which can really help your portfolio and do really nicely, is what they call unbundling. Now, unbundling is when typically a larger company decides to separately list one of their divisions or part of their company. They essentially breaking up into 2 different companies, and in some cases more than two different companies. So that's usually where a large company that's got different divisions that do pretty much different things, and they don't see that they can unlock value by separately listing a company. So whereas you might have started off with one company, now you land up with 2 companies. You get the second company for free because you are a shareholder, and over time those 2 companies can both grow. So on the South African stock market, we've seen this quite often. Anglo American unbundled into quite a few different companies: Anglo Gold, Anglo Platinum, Mondi, etc. all came out of Anglo American. We saw Bidvest unbundle into Bidvest and Bidcorp. I wouldn't be surprised if one day Naspers unbundles some of their assets. I hear there's currently talk of Telkom possibly separately listing one of their divisions. So that's really a nice way of growing your wealth by investing in a share portfolio. Then, worth mentioning that you can obviously buy shares all over the world, and there are thousands of companies listed all over, and you can grow your portfolio by again basically two ways of doing it. You can combine these, but the first way is to buy a portfolio of shares, different companies that you think will grow over the long term, and you can hold on to them for as long as possible, hoping that over the years they grow. That's sort of long-term investing. And the second way is I would call it short-term trading, which is very different. Long-term investing is you're taking a long-term view on the company and companies that you're investing in, and you hold on to them for the long term. Short-term trading, on the other hand, is where you would buy a share, let's just say today, with a view to selling it tomorrow or the next day. But you don't hold on to it for very long, and you're just trying to take a few dollars or rands on your investment, wait for the share price to go down again, buy again, wait for it to go up again, and sell again. You can also use derivative instruments, which I'll talk about in another episode, where you can take advantage of share prices falling, going down, and make profits when they go down, as opposed to going up. That's called going short. But again, that's usually used in shorter term trading. And short term trading, what you need to keep a close eye on the price movements and the charts, and use what we call technical analysis, which is really analyzing the patterns and the charts, and taking advantage of those short-term price movements. So I hope you found that useful and informative. If you have, forward this on to anyone that you might find it useful. If you'd like more information, you're welcome to contact me. That's Warren Savertson at AfriFocus Securities. My email address is warren.s@afrifocus.co.za. You're welcome to contact me there. And we will catch up in the next session. I will be doing more of these type of videos, educational videos, discussing other aspects of the market going forward. So yeah, drop me a line. That's warren.s@afrifocus.co.za, my email address, or you can contact me on the AfriFocus website. Thank you, and we'll see you soon. If you have any questions, put them in the comment section below, and like and subscribe. Enjoy your day. Thanks.